Joining us now is Nic Norman Smith from Lentus Asset Management. Nic, great to have you in the studio with us. How are you taking all this negative news? Are you taking it in your stride? Do you think that there's a lot of opportunity to be found, or do you think this is a time to exercise caution?
No, we think there's a lot of opportunity. Where we would exercise caution is purely staying away from businesses that are expensively priced. And we do think there's a lot of value out there and a lot of attractive opportunities. So no, we're relatively excited.
We were just talking on the platinum miners. I know Ashraf was quite averse to platinum exposure. It seems that you are finding value within this space, and you say that the fundamentals within the space are looking far sounder than the other commodities. Give us your investment strategy there.
The great thing about the platinum sector is that its supply is very, very confined, obviously, in South Africa, basically amongst two producers. So what that means is that you get a relatively rational market. There's not going to be a massive amount of new investment which will flood the market, which we are seeing in commodities like copper, iron ore, etc., where everyone's just starting up a mine, and because the prices are quite crazy at the moment. The other thing is, from a price perspective, commodities track the marginal cost of extraction. The marginal cost of extracting platinum has gone up significantly because of all the electricity issues, etc., in South Africa. So platinum is trading very, very close to the marginal cost of extraction. So the downside is a lot more limited than something like iron ore or copper that are trading at multiples of the marginal cost of extraction.
Ashraf, what is your view on that? It's a good argument, but we know that the costs are increasing dramatically, and actually a lot of these platinum miners are, yes, platinum has priced in a lot of the bad news, but still a higher platinum price would work in their favour.
Look, it does work in their favour, but their volumes are down because motor vehicle sales are down, and that's part of the risk. And as I mentioned in the earlier segment, platinum is not considered a hedge to currencies or a hedge to inflation. Silver and gold are. So unless that perception changes, the demand for platinum is not going to pick up that strongly. And I agree with Nic in terms of the value that platinum miners offer right now. I just don't think it's the right time yet.
The demand for platinum is a lot more broad-based. US, Europe, China, vehicle sector, industrials, other industrial uses, televisions, jewelry, etc. So it's the boring investment, if you want to call it that. The demand is much more broad-based versus China, the diversifieds, which is copper and iron ore. China have the vast majority of that. So what you're saying is, buying the diversifieds or buying a Kumba iron ore, you're taking a punt on China going strong and going great guns. If that falls apart, you're going to be in serious trouble.
But surely if you're buying into the platinum space, then you're also taking a punt on the fact that the developed world is not going to fall into a recession again, and the fact that growth is going to recover substantially, right?
The globe is going to carry on consuming. There may be a rebalancing of where that demand comes from, but China can pick up some of the slack from Europe. But
you've also got some interesting offshore large cap tech stocks for us. Firstly, talk about how you get exposure to them, and I know you're looking specifically at Intel, Cisco, Microsoft and Dell, companies, multinational US companies, but they have, of course, tentacles in emerging markets as well.
Yeah, these are very, very high quality businesses. So cast your mind back 10 years, everyone was talking about the internet and how amazing it was going to be and how it was going to revolutionize the world. And of course, everyone bought into all of these great companies which were going to benefit. They did benefit. The problem was investors had priced so much of that into the price of those shares that the share prices have gone flat, if not down, since then. Yet the underlying businesses have doubled, tripled, quadrupled their underlying profitability. So these are very, very strong businesses, high barriers to entry, which all have individual problems. There's no doubt about that. But we think these are all of these problems are surmountable.
Yeah. Do you agree with that?
Well,
Dell?
I would not agree with Dell, because I just think that they do have a niche position right now in the market, but I see them as a commoditized player. Microsoft I find interesting because the development of the Android system, and when you're looking at smartphones and tablets, Microsoft has not really taken a position there. They have done so recently with Nokia, and the HP tablet is not running off a Microsoft platform, which one would have assumed would be the natural progression for Microsoft. But that means they cut out of a market that's assumed to be growing quite rapidly over the next 10 years. I mean, how do you feel about that as the
I agree with everything you say. The difference is that's in the price and more. So Microsoft's on a 9 price earnings multiple. It's sitting on $50 billion of cash. So, and it's making money in a lot of areas. It makes a heck of a lot of money from Microsoft Office, which isn't going to go away anytime soon. Yes, the Windows platform is going to come under pressure, absolutely, with tablets. It makes a lot of money out of its Xbox, and it's got various other avenues that it's looking into. So all we're saying is that it's so cheap that the bad news and more is in the price. And when that normalizes, you can make a solid return.
What is the expectation for that dividend yield to grow by? I mean, is it 15% per annum, 20% per annum? Because they are sitting on a large cash pile.
Yeah, they're sitting on a massive cash pile, and they wasted quite a lot of it buying Skype, and which was quite a silly acquisition, I think. But it's cheap despite that. So the sooner the better. I mean, I don't know what management are going to do. There's a couple of activist investors who are going quite hard at Steve Ballmer and pushing him to do that. So hopefully the market, hopefully they'll get there sooner rather than later. I don't know, but the business has just done the returns on equity that Microsoft generates are just phenomenal, and it has massive pricing power. And the vast majority, as great as Apple is, the vast majority of computers do run Microsoft at the moment, and it's highly profitable.
How would you, as a South African investor, get exposure to these stocks?
You can buy them directly. So at Lentus we run direct offshore portfolios, and individual. As you know now, there's no exchange controls really. I mean, it's 4 million rand a year. So unless you've really got a lot of cash, that's not too much of a problem. And you can send money straight out there, buy it offshore. And the beauty of that is you cut out all of these layers of fees and asset swaps and various other things that institutions institute.
Do you have exposure to global tech stocks, Ashraf?
No, I don't. I've got global property, but that's it.
Okay, fantastic, gentlemen. We have to leave it there. Thank you so much for joining us. Nic Norman Smith from Lentus Asset Management, and of course, Ashraf Mohammed from Regiment's Fund Managers, who stayed with me throughout the hour. Thank you so much for joining us. Great to have you on the program.